non-callable carry trade. What did you mean?
This is a really interesting technical point. It is a crucial one. Some investors identify securities that they expect will appreciate in price based on high sales or earnings growth. Those are often like tech stocks, for example. Buffett is doing something else. What Buffett is doing is he's not looking to maximize the total return from any given investment. He's looking to maximize the risk-adjusted return. He's looking for assets that throw off cash flow, and those assets have a spread over the funding cost that Buffett has. Like the metric you might use here is called like return on invested capital. So he's looking to compound assets and capture that spread between the return on the asset less the funding cost of that asset. And then with that cash flow, plow back into the business and internally compound. What this shows on the y-axis is the return of an asset, and the right-hand side shows the risk or the volatility of an asset. Most investors are doing is those that seek to maximize total return, they're finding an asset that is high return, but also has high risk. It's just somewhere on the higher end of this blue line right here. Investor A is trying to find this asset. You see that dot on the efficient frontier. It's got high return, but also has high volatility. Okay. Maybe that's like Snowflake, which is down 40%. Down a lot, right? These are risky businesses, right? Because high earnings growth, high sales growth attracts competition. And those names are often glamour stocks. They get bid up a lot. They get expensive, and they have risk of disappointment. Look at cybersecurity stocks, for example, where the forward PEs are very expensive. Now, here's what Buffett is doing. Buffett's saying, I want high return, but I don't want that risk. So he's finding this portfolio, this little dot in red. It has lower volatility. These are cash cows. And he's borrowing with debt to extend the return from this asset on this line here, this diagonal line that we draw from the risk-free rate, which he borrows pretty close to at the risk-free rate as a AAA borrower. Obviously, the insurance float helps as a source of financing. And he is accessing a set of opportunities that dominate the opportunities others have to access in the public markets. If you buy an asset, you're not financing it with AAA debt. You might finance it with margin debt, which you shouldn't do, but that's callable debt. So in addition, what Buffett is doing is he's financing with non-callable debt. That means he cannot get a margin call. So he has permanent capital and permanent financing. He's linking the duration of the asset, which he wants to hold forever, with the duration of his financing. Very difficult for investors to do this in public markets. You can't do it in public markets. You can do it in private markets if you approach your financing carefully.